were met with success. Your first
Modest
entrepreneur success at the age of 30. Some people would argue that you peaked. Mandi hai abhi market mein, right? So that's what people say. You said 30 years.
Yeah, I got the forecast a little wrong actually. India will become the third largest economy before 2030, I suspect.
Another 5 years.
Yeah, as you'd imagine a fund manager does. When my son was born, we did a 30-year CAGR on where the world would be, when the
It's very geeky, but that's why we bet our money on you, right?
So India hasn't seen a classical economic downturn in this century, right? What we've seen is sporadic downturn. Lehman was chota downturn.
ये उससे बड़ा होगा.
Yeah, so this is what we are heading for is a classical downturn in the sense that we've never had one where lots of debt in middle class India, very few jobs, very little private capex.
And then you have Trump also sitting on.
This feels like far more comprehensive than anything we've seen in India for a generation or so, and it keeps me awake at night.
Welcome to Capital Conversations. I'm Samina Nalwala, and with me is the very famous Saurabh Mukherjee, CIO of Marcellus Investment Managers, and of course now also a very famous author. And I shouldn't say now because he's been a successful author as well for quite a few years. Saurabh, thanks for joining us. This time around, this conversation is different. This is Waterfield Advisors, but you're still talking to a large audience who loves watching you. But before I go into business, India, asset allocation, what is looking good, bear market, bull market. Why don't you tell me about your book? It's a lighter, nicer conversation.
So first of all, thank you. Thank you for inviting me. Always good to talk to you. Always good to talk about books. So I'm a
and your book even more.
Bibliophile by heart. So we published Behold the Leviathan. We published Behold the Leviathan 6 months ago.
Okay.
It's about how India is changing in very unusual and unexpected ways. And thankfully the book has sold 16,000 copies. Our publisher Penguin is delighted. But I thought I'll share the book with you at the outset so
Thank
that
you very much.
regardless of how this conversation goes, I at least know I've left something behind.
Yeah.
So here's the book.
Thank you, Saurabh.
Hope you
yes,
enjoy.
guys, if anyone watching this, Saurabh has written many, many books, this being the sixth or the seventh?
Sixth
now. So yeah, 16,000 copies sold. Please
So
feel
this
free.
is how I relax, to be honest. This is how I relax writing books.
I don't know when you have the time, but I'll talk to you about that in a minute. But thank you for this.
Thanks.
Saurabh, I know that every time we've spoken in the past, it's always been about what does the budget have? What is the new government going to do for us? What is Trump doing? But I want to sort of drive this conversation in a little bit of a different format. And I think the first time we met, and I don't even know if you remember, must have been maybe 20 years ago when you were part of Ambit.
Okay.
Right? It's been a long journey. The last 7-8 years is where you've turned entrepreneur. Most of our viewers, most of the people who are clients of Waterfield Advisors come from being the entrepreneur, or at least have an entrepreneur mindset in many ways. You want to start by telling me what that journey was, because it's not easy, to say goodbye to a monthly packet that comes home and CEO of institutional equity. So it wasn't a low-hanging fruit, right? And then taking the plunge and turning into an entrepreneur, a fund manager.
Well, look, the years in Ambit were a lot of fun. I learned enormous amounts. Many thanks to Ashok Wadhwa, Rahul Gupta for helping me see the world, build first the institutional equities franchise, and then we were fortunate enough to get the opportunity to build asset management as well at Ambit. But the interesting thing, Samina, is I was an entrepreneur actually even prior to Ambit. So I migrated to India around 20 years ago now.
Where did you migrate from?
And I grew up in the UK. And then when I was 26, I got together with a few people in London, with my friends in London, and we set up a investment advisory business focusing on British small caps in the UK. So 2003 we got going, and by 2007 when I was 30, I thought life was perfect because we were making money. The firm was called Clear Capital. I was famous. We had a lovely office next to the River Thames. My wife used to work in the building next door, so she.
That's how you found her.
No, so my wife and I go back to primary school. But anyway, we used to have lunch by the River Thames, and then Jan 07, I figured that the British financial system is going to blow up. So all of 2007, we got our clients to sell everything. Jan 08, we put it up for sale, Clear Capital. And we were super fortunate. May 2007, a Portuguese bank agreed to buy us. And we sold that business and migrated to India. So that was my first brush with entrepreneurialism, putting some money on the line, giving up that monthly paycheck, and then getting a reasonable return on selling a small company to a much larger bank.
So you were met with success. Your first
Modest
entrepreneur success. At
Modest.
the age of 30, some people would argue that you peaked. right?
Yeah, yeah.
But you went from being an entrepreneur to being an employee, and then you went back to being an entrepreneur. So now that's interesting to me.
Yeah, so
What changed and what changed again?
So what changed, I guess, was India. We migrated to India.
And why India, sorry?
Okay, let's step back again. So September 07, my wife and I became parents. So as you'd imagine a fund manager does, when my son was born, we did a 30-year CAGR on where the world would be, when the boy.
It's very geeky, but that's why we bet our money on you, right?
So I told my wife that, look, this boy will turn 25 in around 2030. And I said around 2030, India will be the world's third largest economy. So let's raise the boy, and subsequently we were very fortunate to have a daughter as well. Let's raise the kids in India, because if you raise them in the UK, when they turn 25, they will not be able to go to India and cross the Western Express Highway or cross Andheri Kurla Road. Whereas on the other hand, if you raise the kids in India, they can always migrate to the West or wherever they want to live. So that was the premise on which we moved to India, that let's raise the kids in India so that if they want to live and work in Asia, that option's open to them. Because the other way around, it doesn't work, right? If you raise the kids in the Western world, it's really tough to deal with the sharp elbows that characterize Asia.
Do you still stand by the view that India is going to be bigger than it is today in 5 years?
I think,
you said 30 years.
Yeah, I got the forecast a little wrong actually. India will become the third largest economy before 2030, I suspect.
Another 5 years.
So I think we'll get there in 3 or 4 years, given the rate at which two of the economies who are larger than India today are growing. But I think as you get older, you realize that there is a little bit more to life than GDP growth and economic opportunities. What the West gives you is a comfortable lifestyle, stable economies, reasonably well organized societies, where India gives you the excitement, degree of chaos, and unlimited opportunity, right? And as you get older in life, you start craving for the quiet and the peace and the quiet a little bit more. But I firmly remain of the view, Samina, that you create businesses and you find opportunity in chaos, but hey, it's great to holiday in peace. So the West is great for holidaying, but if you want to build businesses, careers, and find opportunities, you'll have to go into chaos, because that's where the opportunities are likely to exist.
So Ambit is where you learn the lay of the land.
That was why I went from being entrepreneur in the UK to an employee in India. I needed to learn about India. It's a different country.
It's a different beast.
And at the age of 30, I started learning again.
And when you again segued into becoming a fund manager, what was that like? How have the last 7-8 years been? It's been 7 years since Marcellus?
So I guess the journey of being an entrepreneur and journey of being a fund manager, for me, they've overlapped in the last 7 years since I left my job. And in a way, the two journeys have overlaps. I'll highlight them, and then I'll tell you what the big difference is. The overlap is that in both, you're trying to take calculated risks. Whether you're an entrepreneur or an investor, you're trying to take calculated risks. You're trying to figure out, where can I deploy my money where the chances of upside are far greater than the chances, right? So to put it in simple terms, my wife and I took our savings and we basically invested $1 million in building Marcellus. And the call we took back in 2018 summer was, well, if it all goes belly up, then I'll go back and get a day job.
Go back to Ambit.
Yeah, go back and get a day job and fund the university education of the kids through that. And my wife made me set aside a sum of money, which would be for the kids' education.
She was the asset allocator.
Yeah, so she was the asset allocator. She said, this money you're not going to touch.
Yeah.
Rest of it you can go and do whatever you want.
Bet the house.
Right? So downside limited, upside hopefully unlimited. So that aspect is, I think, similar, whether you're buying stocks or whether you're setting up businesses. Where there's a difference is in when you're building a business as an entrepreneur, you're making capital allocation decisions largely around, should I hire people, should I open a new business, and therefore the valuation aspect is less relevant. Whereas as a fund manager, the valuation aspect becomes relevant because if you are
the business in so many ways.
Yeah,
right?
And if you end up paying crazy multiples, or you buy a business with crazy multiples going into an economic downturn, you can end up damaging the client's capital, right? That aspect, right, took me a while to learn. And if you ask me the last 7 years, that's been the biggest learning. 2017, when we started this whole philosophy of coffee can investing, as I called it in the book, or consistent compounders, as I call it in Marcellus. 2017, we started that. 17 through to 21, it was like a dream run. We would mint money every year, and we could scarcely believe how much money we were making through that whole simple philosophy as espoused in the book Coffee Can Investing. But then 22, 23 were difficult years. We were forced to learn lessons around how to take more judicious calls and valuation. And looking back, therefore, the big learning of the last 7 years has been focus on clean, high quality companies, but also learn to marry great franchises and great governance with sensible valuations.
You know, you've led me into a conversation that I wanted to have with you any which ways, and you referred to this coffee can investing, and I think that's how you got really famous, right? A lot of people, when they think Saurabh, they think coffee can investing, they think buy and hold.
The book has been translated into Gujarati, Marathi, and soon to be translated into Hindi.
Wow. So yeah, and buy and hold strategy is also what Warren Buffett has talked about many, many times. Interestingly, when I was coming into work, my husband sent me an article by Mark Cuban this morning. I don't know whether you read it, but he very clearly said, and I quote him, build and hold is the second most misleading marketing slogan. It's a little bit of a contra in terms of what you do and a lot of what I do as well, right? How do you feel about it? Because he also alluded to the fact that not everybody may have the luxury of buying and holding. Life happens, right? You may want to buy a house, you may have kids, you may have to pay for university, you may fall ill, you may want to start a new business. And that's when life plays you, right? Shows up unexpectedly. And you may not have the patience or the time to live through a downturn. What happens in that scenario?
Yes, you're right, absolutely. In all of those contingencies, you can't possibly build and hold. So, for example, more likely than not, my kids will end up going to study abroad over the next 2-3 years, and my investments in our global compounders portfolio will hopefully pay for that education if the compounding continues. So I'll have to sell down our global compounders portfolio to pay the fees in whatever UK, USA, wherever it is. However, remember that the whole point of equity investing, right? The first thing you learn in equity investing is only deploy money that you can afford to lose. So coming back to me, using myself as an example, if my losses in my equity investments either in India or the United States are so brutal that I can't send my kids to study into the university system in the West, then hey, I need to revisit that asset allocation, right? So only invest in equities what you can afford to lose. If you follow that principle, then the Mark Cuban disclaimer, I think the Mark Cuban disclaimer becomes a little less relevant. Another way to attack the coffee can proposition, another way to attack it is to say that look, let's take an example, let's take a topical and provocative example. You've bought Asian Paints, it's compounded ever so well for 20 years, and then Mr. Birla comes along and sets up Birla Opus and Asian Paints corrects 40%. So what should you do at that juncture? You had a 40% drawdown courtesy, Asian Paints, great coffee can stock,
Increased
fabulous.
Competition,
but Mr. Birla has come in,
decided to change the market.
Yeah, decided to change the market. So that's where your chops as a fund manager come into play. Have you got a clear point of view on what is Asian Paints' comparative advantage? Can Opus challenge that? How long can they challenge that? How deep are their pockets?
Return to its mean?
Absolutely, right? And that's where the coffee can investing principles, intellect, character, all of it come into play, right? You have to have the intellect to do the analysis and figure out where is Asian Paints, where is Birla Opus. In that battle, if it goes on for 3-4 years, who's going to prevail? You have to have the intellect to figure it out. And then the character to stay the course if you indeed believe that Asian Paints will ultimately.
But it's also the multiples would change, right? So what Asian Paints could quote or quoted a premium for, with increased competition, even if it will survive, which it will, right? These are not businesses that are fly by night. At that stage.
It's a lovely point. So let's again, so this is why writing books is a great deal of fun. So assume Asian Paints is multiple, say it goes from 60 times in the pre-Birla era, say it goes to 30 times in the post-Birla era, right? And therefore you have a transition period, which is arguably what we're living through, where it goes down from 60 to 30. As long as earnings growth reverts to the long-term number of high teens, remember the ROCEs are low 30s. So even if they dividend out 1/3 of their cash, which is what they've historically done, they should be able to get back to high teens compounding, courtesy their sheer cash generation muscle. As long as that sustains, you will revert back to high teens compounding on Asian Paints once these relative market shares stabilize, right? So there's a transition period where I agree with you, the returns are subpar, they have been subpar for us.
And they wiped out significant
quick
upsides,
disclaimer, it's in our portfolios, I'm invested in our portfolios, my parents are invested in our portfolios, our 4,000 clients are invested in our portfolios. So it's been a difficult experience, but remember again, just to turn the whole thing on its head, if you're going to get Asian Paints at 30 times, you're not going to get it when there's no competition. If you're going to get Asian Paints at 30 times, you're going to get it when there are competitors breathing down its neck, right? So already amongst the two contenders who want to take on Asian Paints, One of them has seen their P&L punctured badly over the last 12
marketing
months.
Expense,
right?
yeah.
The other one is still hanging in there, but the other one too is subject to the vicissitudes of the metals market, and therefore we are watching with interest what plays out. All credit to the entrepreneurs who decided they want to build an Asian Paints, but truth be told, there are several people in the last 70 years who had made the same attempt. Everybody wants to run a business which
and everyone wants to be an Asian Paints.
That's right. Everybody wants to be an Asian Paints.
Name.
And therefore, the big learning for me from this was that as long as you can stay the course, you can invest in great companies, be able to stay the course when they're under the pump, and keep asking yourself, keep doing the work to say, in this battle that's taking place, and similarly in banking, it's HDFC Bank versus the supposedly resurgence PSU banks. Keep asking yourself, keep doing the work that am I backing the right horse, or is my horse actually no longer the champion? He's coming second and third best. And if after you've done the work, you realize that here you're not backing the right horse, get off it and
find a new horse.
And find a new horse, right? So coffee can investing as a principle works. As a set of mental rules, I find it very effective. But yes, the Mark Cuban caveat is absolutely correct. Only invest in equity markets. What are you going to afford to lose? If you can't afford to lose that money, then you shouldn't be in
And a whole
stocks.
lot of that is so emotional, right? I mean, we see this often and I don't think it's right anymore. When you have significant wealth, your risk-taking ability improves. But now with what I'm seeing in the last few months, the wealthiest of our clients and families are getting nervous, right? But on that point, and I want to talk to you about this because you're a PMS fund manager, you're focused on equities, right? But Waterfield Advisors is a family office. We look at a broader asset mix, right? So we look at equities, debt, real estate, private equity, gold, alternatives. Where do you see equities fitting in with a multi-asset wealth strategy? Apart from put money in that you can lose or not bring back home, there is probably a far more important role of equity in a portfolio, right? Because you still want to create alpha. You still want to, while people very loosely would say getting 2 to 3% on the index is easy, because it has been in the last few years, managing risk, understanding that creating that alpha year on year is actually significant effort for us as asset allocators and for you as a fund manager.
Look, I mean, I don't have the multi-asset.
But why don't we take a step back? What does your portfolio look like? Is it all equity?
Yeah. So it used to be all Indian equities. My portfolio was almost all Indian equities. We had that safe harbor money that my wife insists on in FDs. But other than that, it was all in FDs until 3.5 years ago, when the penny dropped on me that, hey, the kids are more likely than not to go abroad to study. And
so you've still diversified in global equities.
Right.
You've not diversified across assets.
That to my mind, that doesn't make sense. Because from my perspective, Samina, I don't know other assets so well. You guys as asset allocators.
You should work with us as a client.
Maybe I'll be wealthy enough one day. Maybe one day I'll be wealthy enough to be considered by Waterfield to be a client. But jokes apart, 3.5 years ago, I did the math and I figured out roughly half my liabilities are in dollars. And I said all my assets are in rupees and half my liabilities are in dollars. We know that the rupee gives up roughly 4% of its value to the dollar. So suddenly I felt very stupid. And I began a search for diversification. I actually spoke to fund managers in the Western world. And fortunately for us, that led us to a star fund manager in Wall Street, who very fortunately for us migrated to India and joined us. So now, courtesy Global Compounders in Marcellus, half my wealth is there and half in India. Now, the beautiful thing is India and America are the two least correlated big stock markets, right? And it's working out nicely in this downturn when our Indian portfolio, like other Indian portfolios, is under pressure. Our American portfolio is prospering mightily, allowing me to sleep at night.
Yeah, and I think that's important, and I think we do that at Waterfield as well, right? We do believe very strongly in the merit of geographical diversification.
Right.
But the only difference between the way you may look at it and we look at it is, for us, or for most Indians, the US is the world. What we'd like to believe is that when we say global investing, because we already have a home bias with domestic markets in India. So what we've also tried to do is talk to clients and explain to them that while you want a piece of the US and you still think that's a home bias there, it's important to be allocated to themes in Switzerland, themes in Germany, maybe the Netherlands, maybe Europe, a little bit of China.
I have in our global compounders, we have 25% in continental Europe, 75% in America.
It's a good split.
We think so, but hey, happy to be told that there's a better way to skin the.
Yeah, so we've got, of course, Saurabh doing that. We at Waterfield as well, of course, strongly believe in it.
We don't have China though, so if you guys have
a little bit of China,
happy to learn from
we
you.
also have a very interesting strategy called Megatrends, and this is genetic robotics, AI, high risk, but hence you want to keep your allocations limited. But of course, gives you access to all of that everyone is talking about and worrying about at the same time, right?
And in all seriousness, right, it's not just that the fact that you guys have the products, you also have the wherewithal to help clients understand where is the Indian economy going over the next decade or so, and accordingly asset allocate.
And I think that's becomes extremely important because India is part of the world, and while we're growing at a significant pace, you can't ignore the rest of the world, right? But let's talk about another very important thing which has come to me in the last couple of months, and I think as the market momentum changes, you start meeting customers and customer fears show up as well. High net worth investors still ask about downside protection because a lot of them, for Waterfield as well, are custodians of wealth. For them, it's about transferring the money to the next generation. They're taking significant risk on their business. You want this passive little income to still be protected on the downside, right? How do you manage risk beyond stock selection and diversification? What is it that few things that you do, checks and balances in place, and what I think we do as well as being asset allocators?
So 3 big learnings from, you asked me at the outset, big learnings as, how have I grown as an investor? 3 big learnings for us, right? One is that after that hammering that we took in 22 and the opening months of 23, and we got hammered across our portfolios, right? Till December 21, we were walking on air, and in retrospect, I should have done what I'm going to tell you that we've done subsequently. We should have done this in 21, but hey, better late than never. What we realized through 22, 23 is that rather than position sizing basis the growth potential of a firm, which is what the old approach was, we need to position size looking at both growth potential and the potential for valuation changes over a 5-year horizon. So let's take a quick example. Let's assume that Trent, which is a big part of our portfolios, can grow at 25% for the next 5 years, right? EPS growth of 25%. But at the same time, let's also assume Trent's PE multiple potentially comes off 10% each year. Therefore, the return on Trent is 25 less 10% for the PE rating. Over 5 years, effectively, you're expecting the PE to halve. And therefore, Trent is a 15% compounder in this mental framework. On the other hand, HDFC Bank potentially can grow earnings at 15% for the next 5 years. It's trading at 20-year lows on PE multiples. Not obvious to me that it will derate further. And therefore, even though HDFC Bank is not a darling stock today, HDFC and Trent, companies with 2 very different trajectories, potentially give similar returns over a 5-year horizon, and therefore they warrant similar position sizes. So the old Marcellus would have taken a far bigger position size in Trent, courtesy the higher EPS growth than in HDFC, but the new Marcellus, humbled by the experiences of 22, says let's keep EPS growth and the change in PE over a 5-year horizon, put this in the same framework and position size therein. So we call it the IRR approach, IRR being EPS growth plus expected change in multiples. So that's been the first big change. It has allowed us to recover nicely through the second half of 23 to 24. It's allowed us to outperform in this brutal correction. The second piece was in SMID cap, right? In SMID cap, realizing the importance of loading up on cash. So somewhere around August 2024, we figured out that India is heading into a cyclical downturn. And I did a bunch of trips to Delhi. Whilst writing Behold the Leviathan, I met a bunch of policymakers. And I realized that after 3 good years of strong growth post-COVID, it'll be a 2-year slowdown.
2 years, huh? So we're only 6 months into it?
So it's very rare to have a 1-year slowdown, right? I wish slowdowns were 1 year long.
I know, I wish they never came.
Right. So we started loading up on cash in our SMID cap portfolios from August, and again, it's helped us deal with the downturn, both from a nerves perspective and from a returns perspective, better than would have otherwise. And the third piece that I've learned the hard way is, even though people, a lot of people carry on saying that nahi sasta tikav lo, buy companies which are cheap, doesn't matter, everything has a price, har cheez ka bhav hota hai. I've learned the hard way that doesn't work, right? In a country like ours, where the legal system is whatever it is, where if you have a weak balance sheet, you're rarely going to get out of it. I've learned the hard way that do not compromise on quality. Yeah, do not compromise on quality. The other 2 learnings are kind of reform of our previous thinking, that kabhi cash call nahi lena, or and always focus always to stay on growth. We've learned that marry growth with valuations, take cash calls if you think, especially in small and mid cap, take cash calls if you think over
and
it.
try and time a little bit of it if you
Right,
can, practically then.
and that time it in the sense that if you believe there will be destruction of capital,
Pull out.
take some of
A
the
little
money off
profits
the
off the
table.
table.
Right. In large caps, it doesn't worry us so much because in our consistent compounders portfolio, these are large, liquid, high quality names. But in our mid cap portfolios, whilst I love to believe they are great quality, they are smaller companies.
No, and I mean, you're talking about large caps. Look at what's happened to Tata Motors in the last few days.
Right.
So it's still down 40%, right? Who would have thought?
And the more certain person in America talks about setting up a plant in India.
The unpredictability is what's causing all this. But okay, let's talk about behavioral tendencies, right? Many investors, and we've been talking to a lot of them. I mean, I think we're also over-engaging because families are getting nervous, markets are not behaving the way we would have liked, even though we have anticipated this correction just like you. So we've sat on dry powder since
Fabulous.
October, right?
Congratulations.
So we're about 10-20% of portfolios that are sitting on cash. Tactical calls always have their merit, even though we deploy in a staggered manner for the long term. But what we keep hearing, and I don't know, you probably face this from some of your investors too, that markets are falling, fund managers should do something, right? As an allocator, we try very hard to manage this behavioral tendency. But how do you educate your clients that are common to you and common to me, and tell them that, you know, maybe acting or not acting is also an action, right?
So I think here I have a learning. There's the entrepreneur in Saurabh is often the worst enemy of the investor in Saurabh, and the reason for that is entrepreneurs have a bias towards action, right?
And risk,
So entrepreneur को लगता है कुछ कर रहे हो तो बढ़िया कर रहे हो. If you're not doing anything,
the problem is
loser, right? Whereas, as you're alluding to, most of the legendary investors have said that investing is lots of reading, long periods of inaction, very little trading. And I think the entrepreneur in Saurabh tries to restrain himself from mixing up that with the investor in Saurabh. And I'm very fortunate to work with a bunch of colleagues for the last 20 years. The same group of people. They know my bias to action and they shoo me out of the office. Or they ask me to shut up in meetings when they see that the entrepreneur...
It's a veto then.
Right? It's a veto. But the veto, I've realized that often the veto shouldn't be exercised because people are checking you. But jokes apart, I think some of your clients perhaps, will over time realize that the entrepreneurial instincts which have made them successful in their day job might get in their way.
Yeah, and surprisingly, that's what we've seen. And I think you'd agree that a lot of very successful businessmen are not very successful investors. It's probably because of this
the bias
conscious,
to action.
need to do something, right?
Yeah.
I'm going to put this in the most polite way, and often we tell our clients that a robust process beats short-term luck, right? I mean, it's consistency over intensity. How do you think fund managers, or do you think fund managers may sometimes be glorified a little bit too much? Because if it's about buying and holding, and there's a lot of macro factors that could be playing to our benefit or playing against us. What do you think? Too much glorification for Saurabh in the good times, and of course you get beaten down as well.
I don't think there's any two ways about what you're saying. There's the glamorization of our profession in India, I think is over the top. In fact, it's very interesting. Leave aside the fact that financial services as a profession is overhyped in our country compared to other far more laudable professions which are adding greater value to the country. But even within financial services, what I find bizarre is that, say, versus the asset allocator, the wealth manager, I don't think gets their due attention relative to the fund manager, right? Because after all, whether I like it or not, were it not for asset allocators like you, we wouldn't get the AUM. And I find it very interesting that on the Western Express Highway, there aren't hoardings of asset allocators.
We do the little bit of the holy job, right? We're telling you what to do. We're not after your money.
I think some glamorization of your profession would help. Not least because it'll get more talent to come towards your profession. By my estimation, there's only 500 of us in India, right? And I think we need a few more fund managers, but I'm not so sure hundreds more fund managers will help that much in an increasingly efficient market. But we need tens of thousands of more asset allocators and wealth managers and people who can hold clients' hands. The SEBI website says there are only 1,200 investment advisors in the country. That sounds bonkers.
And also the industry sort of in so many ways is conflicted, right? I mean, you can't say this, but I can definitely say it, because a lot of the products that come to clients or to families are push products. You know, banks are still pushing for insurance, NBFCs are still doing what they're doing, distributors, product manufacturers, the whole industry is skewed towards, to some extent, a conflict-based model, right? And I think that's where institutions like us tend to shine. It may not be as glorified, but what I do know for a fact is that we've become the munim for a lot of our families, right? While you focus on equities, we have no choice but to talk about every other asset. And for us, investment management is part of wealth management. What you're doing is investment management. For me, the journey is so much
You're
more,
the
right?
superset.
We have no choice but to, and we've learned it the hard way in so many ways, right? You've got to be relevant. You've got to be able to make that call on real estate, even if you prefer equities. You've got to be able to say, listen, gold is looking good. You may not be able to say that, but we do say it. And I think asset allocation has its merits, right? It's just staying the course, rebalancing. So much of it is underestimated.
Humbling for us to learn, right? One of my colleagues in sales recently told me that apparently 90% of the returns
is asset allocation.
Is asset allocation.
You denied that, I'm sure.
I'm not denying it. I'm saying I agree with you.
Yeah.
Especially since my portfolio has benefited from allocating to global compounders and to the Western world. I've realized that asset allocation is a bigger driver than stock selection.
And I think also sort of managing risk. So while geographical diversification may be good for alpha, all of that said and done, what investors also need to realize even more is that when you feel like everything is falling, and sometimes it does happen, it's when you look back and sort of look at it from a more extended time horizon, the merits of geographical diversification are very evident, right? So yes, so many things that we can go into. But another question that I want to ask, and as an allocator, we look for opportunities across asset classes, right? It's not just equities. But I'm going to focus this question on equities because I think when we talk to people as well, market mein kya ho raha hai? Matlab kaun si market mujhe puchna padta hai kabhi-kabhi. But do you believe that Indian equities still have deep inefficiencies that a stock market picker can exploit? Till a few years ago, information arbitrage was available. Today, information arbitrage is almost nil in the large cap space. Everything that there is in the broader market universe. But do you think that still exists?
Yeah, I think three big inefficiencies still persist, right? Liquidity remains a massive challenge in India. Even after this 6-7 year rally in markets, outside the top 70-80 stocks, we struggle to get liquidity. And by my estimation, amongst the 10 largest stock markets in the world by market cap, will be right at the bottom in terms of liquidity for every dollar traded in the market. Second issue, I think, is accounting and governance. Still a significant issue. Better than it was 15 years ago, better than it was 10 years ago. But the forensic models that we run, and we do this every year in December after all the annual reports are out, the forensic models that they run show very clearly that the last 3 years rally has been led by low quality stocks, right?
Yeah, we've all seen that. Railways, defense, you name it.
So purani picture फिर से repeat हो रही है, and it'll all come crashing down over the next couple of years, I suspect. But hey, on the second inefficiency is accounting governance, still plenty to be done.
In a situation like that, where you know I know we say past performance is no way to indicate what happens in the future. If low quality companies, sectors that have been struggling, right? I mean, look at the smaller sectors. They've never made money in terms of the business owners, but stocks have gone out of whack and investors have made money. And a lot of these stocks wouldn't show up in any solid mutual fund or any solid PMS, right? Doesn't that become really tough? Because on one hand, you have TV channels rolling out advice about what to buy intraday, and there are people making money, let's not forget. But on the other hand, it's you who are doing the hard work, strategically identifying companies that look good, where there's an opportunity, there is growth, valuations look good. How does that work? And we say this often to our clients, right? Our biggest threat is your college friend who tells you, I made so much of money.
No, I think
where you made it.
Everybody in Mumbai has told me that they've made more money than
you.
I have.
Or your investors.
And I completely agree with them. They've made more money in the last 3 years than I have. Not just the taxi driver and the auto rickshaw driver.
And the
pan wala. Everybody has made more money than we have in the last 3 years. I completely agree with them on the Indian portfolio. They have. I'd love to have this discussion with the same people 3 years
3 years
out. The reason I don't
But what if they cash out now?
If they could, that'll be great.
Then luck comes in.
If they can find liquidity in those counters to sell, I would love to know. But jokes apart, my reading is most of the people who have bought the crap over the last 3 years, the crap has done really well.
Yeah.
Right? I know who they are.
Yeah.
I know their size of their portfolios.
Yeah.
And I'll be astonished if they can get
any
money out as we go into.
So let's just, I know we shouldn't keep this very specific, but you did indicate that the next recessions or downturns last 2 years.
6 months ago I said 2 years, now I'm going to say 1.5 years.
Okay, so 18 months are going to be tough. What do you think, and how would you view this as you're an investor? What would you tell investors to do?
So
take profits off the table.
Three things that
we are saying please allocate, right? Of course, allocate over a longer period of time because opportunities will show up. But would you not say that take profits as well?
So the only thing that I can do in terms of asset allocation is the Mukherjee family portfolio. So the 3 things I have done there is reduce mid cap exposure, increased.
So reduce means you're not simultaneously adding more.
No, so I've taken some of my mid cap holdings in India, sold them in August, September, October, put them in our global compounders portfolio. So reduce mid cap in India, increase dollar exposure, and inside mid cap, increase cash.
Okay.
And then whatever bonus I got from Marcellus this year, put a significant chunk of that in cash in preparation for what I think will be 1.5 really tough years. So increase my cash, reduce mid cap, increase my investments into.
I'm telling you need to talk to Waterfield. We'll do all of this really well for you now.
I think I need 3 more years of compounding to be.
No, we have a bespoke segment also. Don't worry.
Thank you so much.
But okay, Saurabh, I get asked this because of course it's a mandi hai abhi market, right? So that's what people say. But where else to invest, right? If a wealthy client or a multi-generational family reaches out and says, apart from equities, where else should I invest? I'm saying global markets as equities because it's an equity-heavy portfolio, which is your dollar portfolio.
So I think there are 3 places in the world which look very juicy to me, right? Kash paise hote karne ke liye. So first place, I'll quickly plug my book. In the last chapter of this book, we have highlighted that India has around 4,000 unlisted companies with PAT between 50 crores to 500 crores.
Unlisted space.
Right? So unlisted may family-run cash-generative companies where there is succession planning issues. So I wish I had money, but I don't. Those of you who are watching and you know of unlisted companies who are cash-generative and have family-run succession issues, there will be a whole class of, I think, private equity that will emerge to help these companies deal with succession and then ultimately list these companies. Second is US and European mid cap. So because of the obsession with Magnificent Seven in the Western world, American mid caps are trading at lower than the Nifty, significantly lower than Nifty, with growth in EPS 3x that of the Nifty, right? So I think powerful combination, cheaper multiples, but way higher growth rates than the Nifty in terms of EPS growth. The third area is Indian large caps as a percentage of India's market cap. Indian large caps are trading at 20-year lows, right? So HDFC Bank, another Marcellus portfolio holding, is a case in point. We're going to have real difficulties in the financial system over the next 1.5 years. I would love to see what happens to the.
So in cases like that, would you double down?
We've already got 8 or 9% of our portfolio in HDFC Bank. I'll go and discuss in the office whether we should buy even more.
Yeah. No, because we strongly say that, right? We strongly believe that if you own the market, you can't beat the market. You need a concentrated portfolio, right? And if you don't like something, it shouldn't be there. If you like something, you double down.
The only thing is, if you run a concentrated portfolio like we do, you should be prepared for the sort of hair loss I've suffered in the last 3 years.
I agree. But okay, talking about concentrated risk, and again, a lot of our clients land up having significant wealth tied up in their business. Now, these are listed companies, unlisted companies, even employees, right? CXO level employees with stock options. We've talked about how having a little bit of a concentrated portfolio, apart from the hair, has some merits, right? Do you think these individuals who know the businesses the best should look at diversifying?
Yeah, I think so.
And if yes,
I think it's a very
why?
interesting point, right? If you have, I mean, obviously, if your options are still options, then they haven't been converted to equity. There's not much you can do. But if your options have become equity, I've always believed you should then view it just as rationally as any other.
And it becomes your passive
there's no
piece.
point having a sort of home company bias कि मैं यहीं पे काम करता हूँ. Let me stick half my life's portfolio there.
Even though you did that.
No, so in Marcellus, we are both Marcellus and my startup. I had no choice. I mean, this is unlisted,
you needed your corpus,
right? But if Marcellus were listed, I would have to be far more rational in mind.
No, but sort of even in the unlisted, so we have a lot of families who run very successful businesses. They may not be listed, but most of their money goes back into the business.
So that's an interesting point. If your business can compound or generate ROCEs of 20% or more, then I think it's great to reinvest back into the
and that's where I struggle with finding merit. So I'll give you an example. We were discussing with my husband, we were discussing a perfume business. The ROI on it is 17%. Now at 17%, what is the decision? Am I doing this to entertain myself, or do I give that to a fund manager like yourself?
Yeah, so I think 17% post-tax 13-14, then
Kya
I think
fayda hai, right?
it's far better to asset allocate back into the markets. Yeah, but if it's I think your
but most business will also only give you 17%.
That's right. That was what I was getting at. That most businesses will give you high teens returns, net of tax, mid-teens returns. In that context, diversification makes a great deal of sense. And I suspect a lot of what the Indian business community is doing in the last 5 years is just that. And I think that trend will continue. Perhaps the bear market might dent it a little bit. But by and large, most people will increasingly be rational, especially if the kids say that, Mom, Dad, I don't want to work in the factory, the family business further.
Which is what a lot of the second generation is doing. And those are a whole bunch of our clients, right? So a lot of the conversation that we have now with families is so much more than asset allocating and investment management. It's actually questions like these. Succession planning. What do we do with our business? How do we run the governance? Do we sell it?
I can see the Waterfield Succession Planning Private Equity Fund, by the way.
Yeah.
I think that'll be a good idea.
Yeah, should we? Maybe we should talk about this after the show. But okay, let's navigate a little bit away from the markets. And why don't we talk about you, right? Because it's always good to get in the mind of the fund manager. And I know Kshitij was very keen that we do this segment because people do enjoy, I think people love knowing more about other people, right? But you are somebody who manages public money. In many ways, you're even responsible to the public. And of course, in the good days, you have everyone backing you. In the bad days, everyone's going after you, right? Be it peers, be it clients, but that is life, right? And you also like to educate people. Every book of yours tries to tell people what they should do, people who may not be able to afford in the master list, right? And you are sort of the father, sort of the husband, sort of the investor. But tell me, what is the role that you enjoy the most? And please don't say father because that's very cliche.
So look, I mean, writing is relaxation. So our job involves lots of...
Is this making money for you as well?
It pays for the vacations, I guess.
Right? Not bad.
It pays for the vacation. But yeah, so we end up spending a lot of time on planes, and around a decade ago, I realized all that time on planes, rather than listening to music, you can write, right? So I find it incredibly relaxing. And Saturdays, Sundays, so every Sunday morning, we publish something called 3 longs and 3 shorts. Whatever we've read over the week, we summarize it for.
Comes into our main box.
There you go. So that gets written on a Sunday. So the subsequent Sundays one gets written the preceding Sunday, and at home it justifies me spending the Sunday morning reading for 4 hours, which might not please everybody at home.
Yeah. If you're working Monday to Friday and writing on the weekend,
but this is what
happens to family time?
The Sunday reading is relaxation, right? So other people relax with music. I relax through reading.
Me time. That's what you're supposed to say.
So the me time is the reading time.
It's the cool thing.
Yeah. So me time is reading time, and it is what it is. I relax by reading and writing. My wife, who I've known since primary.
What does she do? Just start.
So she's a designer. She designs people's houses for them.
Interior designer.
She's aesthetically oriented. She has far better social skills.
Okay.
So whatever social life we have
is thanks to
her social skills.
Thank God for that.
And I get tutored by her on how to behave in these social occasions. And I'm
surprised you show up.
No, I mean, I suppose you've read my personality. But for example, this evening, it's a weekday evening, but we'll still go to a party, and I've been told what to wear and how to behave. So that keeps me on the straight and the narrow, and gives me a sense of normality. So that's it. I think that's about all there is to my personal life. It's not very interesting, I'm afraid.
This is all of us. It's called midlife crisis, but that's okay.
Thank you so much.
Saurabh, the question that I've written down for you was to ask you, you've worked with so many intelligent people, right? And what's the one lesson that has changed the way you think about wealth? But I'm going to change that question around. And I'm going to ask you, you meet multiple clients, and some of your clients will be very wealthy because in allocations of PMS still comes with a minimum ticket. What is the smartest advice you've had from a client?
So it was around 11 or 12 years ago. It was after I published my first book. It was called Gurus of Chaos, and it was kind of book launch type party thing on one of the terraces in Mumbai. And this gentleman, who's worth, I guess, $5 billion today, at least public basis, the market cap, maybe his personal wealth will be more. Anyway, he came to me and said, I like the book. And then he said, Gurus of Chaos, you have said what other people think, other fund managers think. I said, these are the people who taught me a lot about investing. So Gurus of Chaos is about fund managers, say my friend Sanjay Bhattacharya, the erstwhile legend at Templeton, Siva Subramaniam. So I said, yeah, I've learned a lot from these people, and I thought I wanted to let the rest of the world know. He says, but aapki soch kya hai? What do you think? I said, why do you want to know what I think? He says, look, as you get older, right, worry less and less. As you get older, worry less and less about what other people think, and focus on what you think is right. Right? Because increasingly you'll realize, and when he said it, I didn't fully understand the significance of it. It took me a decade to understand the full significance of what he said. As you get older, you'll realize how you see the world and what you think is right is more important than
what the world wants you to see.
What the world wants you to see, right? So when I hung up my boots in my day job as the CEO in my previous firm, and I started this journey, I said, "Ab to sab kuch."
Are you still good friends with Ambit?
Ashok and I meet, and I still learn lots from him. Great guy to learn from. Rahul and I meet at the Four Seasons for a drink every few months. As a friend, I had a lot of fun. Learned a lot.
They groomed you in so many ways, right?
Yeah, they created me. Whatever we are today, whatever the way we see the country, I think a lot of it came from those years in Ambit.
An unpopular view on the Indian markets.
Unpopular. I think what's happened in the last couple of years, whilst it is capitalism and free market, I think is unfortunate. A lot of retail investors, a lot of people, ordinary families have taken money out of their savings accounts and put it in mid-cap funds. I think there'll be a price to pay for that. In the opening pages of Behold the Leviathan, I've said that we had 30 million retail investors in India 4 years ago. Today we have 170 million. In a country where only 30-40 million people pay tax, that means we have 100 million plus people who are not rich enough to pay tax.
But they are rich enough to invest in the markets and bet the house.
Who have punted their life savings on the market. I think that is unfortunate. I know it's free market capitalism and the regulator shouldn't step in, but given that we are amongst the 50 poorest nations in the world and we don't have a social security system,
please be careful.
It doesn't feel fair.
Yeah,
feel fair.
And I think that's what we've seen, right? A lot of people that we work with maybe the niche in many ways, and I think that's what we've learned, right? There is no free lunch. You've got to put your head down and work hard, right? What has happened in the markets in the last few years is like the pan wala and the auto rickshaw wala have all made money without even knowing how to read a financial statement. So
a lot of people have borrowed money to invest in the market.
Yeah. And this is what we saw many decades ago, and it feels like history is repeating itself. But yeah, that's what you want to be careful about. And it's your hard-earned money. Please be careful about it. The most overrated investment advice you've given and you've heard.
The most overrated I've given is in that 2020-2021 bubble boom, whatever you call it, the fact that you can own stocks regardless of what PE multiple they get to.
So price is an important.
When you know that you've got we call it over earning now. We didn't call it over earning. I wish I called it over earning in 2021. When you know that the E has been jacked up by COVID, and the PE has been jacked up by COVID, and aap mein itni akal nahi hai to realize the E and the P is jacked up, then you deserve what we got in 2022.
This is not part of my question, but it's a client that I spoke to recently, 72 years old, and made quite a bit of wealth, right? And she asked me this. She said, all this is great, buy and hold, ye karo. She said, how many years do I have left? When will you tell me, take my money out and enjoy it? When do you tell your clients, take your money out and enjoy it? Because this is all great on paper.
So we don't
and
get
this is great for university. We'll send our kids to study, I don't know, MIT, Harvard, fashion at NYU, I don't know.
Affluent Indian families' life expectancy is 85.
So cash out at 83, you're saying?
Yeah, roughly, yeah.
Come on, Saurabh, yaar, then pay for hospital bills.
And median age in India is 28. So at 28 median age and most affluent people live till 85. I think there's enough scope for long-term
investing. So just stay
investing.
invested. Stay invested. You may never enjoy it. Your grandchildren will bless you, I guess. And don't lie to me about this, but any market trend that keeps you awake at night. And don't say you sleep well, because you must be worried what's happening in the last few months. You have to be.
Yeah.
Even though we all saw this coming.
India hasn't seen a classical economic downturn in this century. Right, what we've seen is sporadic downturn. Lehman was chota downturn. 2012-13 was specific.
Achha, ye usse bada hoga.
Yeah, so this is what we are heading for is a classical downturn in the sense that we've never had one where lots of debt in middle class India, very few jobs, very little private capex.
And then you have Trump also sitting outside.
And fiscal pressures on the government, and then finally, as you said, right?
Setup.
So this feels like far more comprehensive than anything we've seen in India for a generation or so. and keeps me awake at night. What can I say?
Yeah. And I think on that note, this is what we were talking to Soumya about outside, right? It's at times like these that then asset managers or asset allocators get their day in the sun, right? And fund managers sort
I'm
of
not banking on
give
that.
up their glamour.
I'm not banking on anybody giving me the day in the sun, but I think jokes
for
apart,
us, right? Because this is where our role becomes
You as
even
asset,
more important than a fund manager. In a bull market, everyone wants to make
it's only when you fall ill that you realize a doctor is
doctors need, and that's what we are with those GPs, and you're of course a specialist. But one last question as we wrap up, and this advice is either for our audience that could be ultra HNIs, multi-generational entrepreneurs, family offices, retail investors. To take away from this conversation, what would it be? And it could be personal, it could be professional. I'll leave it to you. Give me both, actually.
I think that whatever I learned a decade ago, I mean, I'm sure many of those listening to this have already figured it out. But I learned that it's what you think that matters. Baki duniya kya bole matters less. And I think everybody who's listening, increasingly as we get bombarded with opinions on social media and broadcast media, the more you can figure out your own point of view on the world, the happier you will be. I suspect the happier I will be if I can find out.
No, and that's so important because at least with somebody like you who's in the limelight in so many ways, right? This is tough advice to follow, but I guess that's the only way to sleep well at night.
Yeah.
Should we say that that's a professional and personal advice going out?
I think it's personal, professional. Well, I have to check with my compliance whether I'm allowed to say.
And also, very lastly, are your kids going to take up after you in fund management?
I have no idea. One of them wants to be a musician, the other wants to be a designer.
So, पैसे बच जाएंगे?
पता नहीं क्या करेंगे. We haven't. It's too early. The frenzied discussions every summer about this.
But thank you, Saurabh. It's always so good talking to you. Thank you very much.
Thank you so much.